The trade everyone built their year around just got repriced. Rate cuts, lower yields, a soft landing into easy money. That was the consensus coming into 2026. It's not the consensus anymore. CPI is at 3.8%. The Fed's target is 2, and markets are now pricing a 30% chance of a rate hike by December, not a cut. One number changed the whole game. Here's what traders are actually repositioning around right now. Inflation has been above the Fed's 2% target for more than 5 years. 5 years. That's not a blip. That's structural. The April CPI came in at 3.8% year over year. That was hotter than expected, and it came at a bad time. Energy prices are rising, tariffs are still feeding through the supply chain, and geopolitical pressure from the Middle East is adding a new layer on top. Here's why this specific print matters for traders. The May CPI drops on June 10th. The Fed meets June 16th and 17th. That's 8 days between the inflation print and the rate decision. 8 days where every trading desk will be repricing the path of rates based on a single data release. That's a VOL setup. And traders who aren't positioned for it are going to feel it. New Fed Chair Kevin Warsh has the Fed's target rate sitting at 3.5 to 3.75%. Markets expected cuts from here. What they're getting instead is a Fed that keeps saying it needs more confidence before moving. More confidence means more data. And the data keeps coming in hot. There are 2 ways this plays out at the June 17th statement. 1. The Fed holds and signals patience. Yields stay elevated. Growth stocks stay under pressure. The dollar stays bid. 2. The Fed leans hawkish. Signals that hikes are back on the table. That's the scenario where the rate cut trade fully unwinds, and the repricing across equities, bonds, and commodities is sharp. The 30% probability the market is already pricing for a December hike tells you traders aren't dismissing option 2. That probability was near 0 3 months ago. Here's the direct market impact. And this is where traders need to pay attention. Yields. Rising yields. Pressure growth stocks. Tech, AI names. Anything with a high multiple and earnings that live far out in the future, those valuations get hit when the discount rate moves up. If the June CPI comes in hot, the immediate trade is higher yields, lower tech. The dollar. The dollar accelerated on stronger than expected ADP, ISM services, and factory orders data. A hot CPI on June 10th adds fuel. A strong dollar pressures commodities, emerging markets, and any company with heavy international revenue. Gold. Gold pulled back from its record highs and is now trading around 4,140 an ounce. The move makes sense. Gold carries no yield, so rising rate expectations are a headwind. But here's the nuance. If the market starts pricing real stagflation risk, inflation plus slowing growth, gold gets a bid again. It's not a simple short. Breadth. This is the one most traders miss. The S&P can look fine at the index level while the underlying breadth deteriorates. In a rate hike risk environment, defensive sectors hold and cyclicals get hit. Watching how many stocks are actually participating in any rally tells you whether the move is real or just large-cap AI names carrying the index. The rate cut trade was long duration, long growth, short the dollar. That trade is now being unwound. What's replacing it is shorter duration, more defensive positioning, and cash levels that are creeping up as fund managers wait for clarity. The June 10th CPI and the June 17th Fed statement are the 2 events that determine whether this unwind accelerates or stabilizes. If CPI surprises to the downside, comes in cooler than expected, the rate cut narrative gets a second life. Yields drop. Growth gets a relief rally. The unwind pauses. If CPI is hot again, and given the energy and tariff backdrop, that's not a low probability outcome. The repricing continues. Hike odds climb. Duration gets sold. And the crowded long positioning in AI and tech becomes the risk. This is why the next 2 weeks are one of the highest information windows of the year for traders. Not because it will be easy, because the range of outcomes is wide and the positioning is extended. Sticky inflation just changed the rate cut trade, not ended the market, but fundamentally changed how you have to think about positioning right now. June 10th, June 17th. Those are your dates. Watch the CPI print. Watch how yields respond. Watch where the dollar goes. And watch breadth, not just the index number. If this is the kind of market breakdown you want every week, subscribe. New analysis every week. No fluff, just the levels and the logic that matter. Educational content only, not investment advice. Trading involves risk. Do your own research before making any decisions. See you in the next one.